acted on impulse. In volatile markets, emotions can quickly override logic. Trade smarter with indicators. You've already built a solid foundation in technical analysis. Now it's time to level up. In this lesson, you'll learn what indicators are, how to use them, and which types are best for spotting momentum. Let's start. You've likely heard of indicators. Let's break them down. They're math-based tools that analyze price or volume to help you spot trends, momentum shifts, and key market signals. They're designed to help traders understand what the market is doing right now and what it might do next. They're not direct buy or sell signals, but tools to guide decisions by highlighting patterns and market behavior. Every strategy needs the right tools. Trend indicators like moving averages show direction, while momentum tools like RSI or MACD spot shifts or reversals. This may sound complicated, but do not worry. I will guide you through every indicator in the upcoming lessons. So the thing is, price charts show market movement, but not always the meaning. Indicators add context, confirming trends or questioning momentum to reduce guesswork and improve your decisions. Have you ever second-guessed a trade or acted on impulse? In volatile markets, emotions can quickly override logic. Technical indicators help remove that uncertainty by offering consistent data-based signals. By relying on objective tools rather than gut feelings, you're more likely to follow your plan and make disciplined, well-timed decisions. Consistency is another key to developing a sustainable trading approach. Indicators allow traders to apply the same logic across different trades, reducing variation in how decisions are made. With clear signals and repeatable rules, you can measure their performance more effectively, refine your strategies, and improve over time. Lastly, the market is full of information, and not all of it is useful. Indicators act as filters, helping you focus on what matters most. They take the complexity of price movements and present it in a way that's easier to interpret and act on. That said, using too many indicators can be counterproductive. The goal is to find a small set of tools that support your strategy, tools that help clarify the market, not complicate it. Knowledge check. Why should you use indicators? Let's put your knowledge to the test. Select the 3 main reasons traders use indicators. Excellent. Now that you understand why indicators are essential, it's time to look deeper. Not all technical indicators serve the same function. Most fall into one of 2 main categories: leading and lagging. Let's take a closer look at each category. Leading indicators are designed to anticipate future price movements. They analyze current market conditions to suggest where the price might go next. Traders often use them to identify early signs of reversals or shifts in momentum before the actual price move occurs. While leading indicators can offer earlier entry opportunities, they also carry a higher risk of false signals. They are most effective when used in combination with other forms of confirmation. Lagging indicators are used to confirm what the market is already doing. Instead of predicting future movements, they validate trends that are currently in progress. These tools are often based on historical data and smooth out price action to reduce noise. Because they react after a move has begun, lagging indicators can help traders avoid premature entries and stay aligned with broader market trends. They are especially useful in trend-following strategies where confirmation is more important than early entry. Leading versus lagging. What's the difference? Can you tell which indicators act first and which follow? Match each type of indicator to its correct description. Well done. You now know what technical indicators are, why traders use them, and the key difference between leading and lagging types. In the next lesson, we'll dive deeper into leading indicators. You'll learn how specific leading indicators work, what they reveal, and how to use them to identify potential market moves before they happen. How to spot a trend before it happens. As you already know, successful trading isn't just about reacting, it's about anticipating. That's why traders use leading indicators. In this lesson, you'll learn what leading indicators are, how they work, and how to use some of the most popular ones in your own strategy. True or false, a leading indicator is used to confirm trends after they've happened. Yes, you're right. Leading indicators are used to predict future price movements before a trend starts. They're meant to help traders anticipate what might happen next, not confirm what already occurred. Excellent. Leading indicators measure how the market is moving. A key focus is momentum, the strength or speed of a price move. Fast, strong moves, GIR rising momentum, 1. Slower moves, GIR weakening momentum, 2. When momentum fades, it could mean the current trend is running out of steam. If momentum is rising, it's often a sign to ride the trend. Enter trades in the direction of the move and stay in as long as momentum continues. When momentum slows, it may be time to prepare for reversal or tighten your stop loss to protect profits. By watching momentum closely, you can make better entries, exits, and avoid getting caught in weak trends. Time for a quick quiz. You see a bullish market with 3 entry opportunities: Phase A, B, and C. Each phase reflects a different level of momentum behind the price movement. You're looking for a safe and efficient entry, not too early, not too late. Where would you jump in? Phase A, Phase C, Phase B. No, the correct answer was Phase B. Close. Phase A might be too early and Phase C too unstable. Phase B hits the sweet spot. Momentum is still strong, but price action is more stable. Another key element leading indicators focus on is market pressure, the ongoing tug-of-war between buyers and sellers. When buyers have the upper hand, prices tend to move higher. When sellers gain control, prices often begin to fall. Leading indicators help detect these shifts in pressure before the price actually reacts. Spotting changes in buying or selling pressure early gives traders the chance to prepare for trend reversals, breakouts, or breakdowns with stronger timing and better risk control. Knowledge check. Reacting to market pressure. Understanding who's in control, buyers, sellers, or neither, can help guide your next trading decision. Match each market pressure condition with the most suitable action. Tracking momentum and market pressure sounds complex, but you don't have to do it by hand. Leading indicators automatically analyze this for you so you can spend less time guessing and more time making smart trades. Now let's explore 3 of the most common leading indicators. The first one you'll learn about is the Relative Strength Index, or RSI. It measures how strong recent price movements are and shows whether something might be overbought, too high, or oversold, too low. The RSI gives you a number between 0 and 100, and that number can help you decide when to enter or exit a trade. Quick task. How do traders use RSI to make decisions? Move the slider to different RSI values to see what they might tell you about the market. In other words, RSI can help you catch potential reversals, times when the market might change direction. Here's the simplest way to use it. RSI below 30, market may be oversold, potential buy signal, RSI around 50, neutral zone, no strong signal, RSI above 70, market may be overbought, potential sell or take profit signal. A relative strength index reading of 72 may be a signal to consider buying the asset. Yes, you're right. An RSI of 72 means the market may be overbought. That's often a sign the price could pull back soon. Instead of buying, traders usually wait or look to sell when RSI is above 70. Now let's move on to another popular leading indicator, the stochastic oscillator. It helps traders spot momentum shifts by comparing the current price to its recent range. In other words, it shows whether the market is losing strength or ready to turn. The stochastic oscillator gives you two lines that move between 0 and 100. The first line, called %K, shows the current momentum based on recent prices. The second line, called %D, is a smoothed version of that first line. It helps confirm the signal. When the %K line crosses above the %D line from below the 20 level, it can be a buy signal. When %K crosses below %D from above the 80 level, it can be a sell signal. This crossover helps traders decide if the change in momentum is strong enough to act on. Knowledge check. Matching the stochastic behavior with the signal. The stochastic oscillator helps spot shifts in momentum, especially during overbought or oversold conditions. Match each behavior with what it likely means for your trading decision. Now let's explore another leading indicator, Fibonacci retracement. It helps traders find potential pullback zones, places where the price might pause or reverse before continuing its trend. Traders identify a significant price movement, either upward or downward, and apply the Fibonacci retracement tool from the start to the end of that move. The tool then plots horizontal lines at key Fibonacci levels, 0.236 or 23.6%, 0.382 or 38.2%, 0.5 or 50%, 0.618 or 61.8%, 1.0 or 100%. Traders often treat Fibonacci levels as key decision zones during a pullback. When price reaches the 0.382 level, it's seen as a shallow retracement. This suggests strong momentum, and traders may look for early opportunities to rejoin the trend. The 0.5 level, although not a Fibonacci ratio, is widely recognized as a common pause point. At this level, traders typically wait for confirmation before entering or adding to a trade. The 0.618 level, known as the golden ratio, is one of the most closely watched. It's often seen as a strong potential reversal area where traders may place entries, stop losses, or take profits depending on their strategy. Quick task. Fibonacci retracement in action. Every great Fibonacci setup starts with a process. Can you arrange the steps in the right order to find key levels and plan your next move? Excellent. You've just explored how leading indicators help traders anticipate what the market might do next, rather than simply reacting to price movements. You now understand how momentum and market pressure work, and how leading indicators can help you identify potential turning points, entry opportunities, and key reaction zones. But this is only part of the picture. In the next lesson, we'll focus on lagging indicators.